Yeah.
All right. Hello, everyone. Welcome to today's First Friday, November webinar. My name is Marissa, and I will be the administrator for today's meeting. Today's presentation will be about 15 to 20 minutes, and we'll be covering what created our inflationary environment, what must be done to fix it, what the U.S. stock market is missing, and based on the data we have today, our base case for the stock market's fair value. If you have submitted questions, we want to thank you. Those questions help us understand what's truly important for each family we serve. If new questions emerge from the content of today's presentation, please either send the question along by writing in the chat box at the bottom of your screen, or you can write your question down and we'll do our best to come to you at the end of the prepared comments. Please remember to keep your microphone muted and to stay on mute as background noise is audible and distracting. With that said, let me turn the presentation over to Stephen Abernathy, who will provide today's commentary.
Hey guys. Hey, hello everyone. Thanks for tuning in. And as Marissa said, welcome to today's First Friday, November webinar. So today we're going to spend 15 to 20 minutes about, as Marissa said, what created our inflationary environment, what's going to be done, what we really have to do to fix it. And more importantly, what the stock market is missing, and based on the data we have today, our base case for stock market's fair value. So, and as Marissa also said, if you've submitted questions, I really do want to thank you, because those questions help us understand what is truly interesting and important to each of the families that we serve here. If new questions emerge during the content, just put them in the chat box, or at the end, we'll come back to you for to ask them if you'd like to, and the recording will stop before we go to that point. And as Marissa said, please try to remember to keep your mic muted until the question and answer. So we believe, as you can probably tell so far, that we are entering a difficult period for investors, and our goal here today is to help everyone develop reasonable expectations for the future. We're going to continue to have these meetings on the first Friday of every month for another 4 months. If these meetings are helpful, then we're going to continue them. If they're not helpful, or if something's wrong, or if I'm wrong and the future is really rosy, like I don't think it's going to be, then these meetings, the first Fridays, will be unnecessary unless everybody would like to keep going. So the last thing I'd say is, after this meeting, just please help us know what's helpful and what should be avoided during these meetings, because these meetings are for you. So let's talk about what helped us arrive at the point that we're in today. And, some have asked why we care about how we even arrived where we are. We know where we are, so who cares? And it's a fair question. The reason we're evaluating where we are and how we arrived at this particular point is because our U.S. economy is in trouble. I'm educated enough to know that. And the events which got us into the trouble in the first place may very well show us how to get out of this trouble. And that's what we're hoping for. Here's a depiction, or here's a slide, which shows the aggregation of our national debt load. Today, we find that our U.S. economy has the highest amount of debt in history. This is a pretty shocking slide to me, to anybody that has sort of a physical interest. Slide 3 documents the amount of debt and the pace at which the debt has accrued. As you can see, it took us well over 200 years to amass the first $1 trillion in debt. It took us 30 years to amass 12 times that amount, 12 times what it took us in 200 years. And finally, it took us 10 years to double that amount, over 25 trillion in debt. Why is this important? So documented research shows when an economy or any economy becomes more than 90% indebted, the growth slows. And today our debt level is very close to 140% of GDP. So not 90%, 140% or more. That's by very conservative calculations. The reason this is important is the simple answer that over 800 years of history clearly demonstrate that the economy has more than 90% debt in relation to its GDP, and it spends the majority of its revenues. When this happens, and debt exceeds 90%, each of the nations have to spend an inordinate amount of their debt or inordinate amount of their revenue to service the debt, interest, and pay it off. And as we'll see in the next couple of slides, the pace at which we've infused debt into our economy, it really matters. So let me show you a couple of things. So as you can see here, this is slide 4. Today, the U.S. has debt which represents more than 140% of debt, as we said earlier. The point of this slide is just to demonstrate that the greatest risk to our economy over the near term, it's inflation. And whenever it's the pace, in this instance, it's the pace at which the infusion or the money has taken place. Our government pumped more than $10 trillion into our economy in less than 3 years. This doesn't count for the trillions, I mean literally trillions of debt corporate America added to its balance sheet, yet we'll get to that soon enough. But what should investors expect over the next month? Is inflation truly a threat to our economy? And will the US Federal Reserve continue to increase rates? Well, the US Federal Reserve has no choice. They must continue to increase US interest rates and to decrease their balance sheet. It is a must. They're in a corner. Investors should expect higher rates, less liquidity, both of which will create an uphill battle for investment values. So when people say, don't fight the Fed on the way down, they're also talking about don't fight the Fed on the way up. Don't forget. So yes, inflation is a threat to our economy, yet it may not be a threat for the reasons most people believe. The money infused into our economy created more demand for goods and services than our economy can handle. That's easy to understand. The government knows this, and everyone knows this, and they're trying to correct it. Here's the real problem. The correction means that they have to figure out a way to remove the majority of this money they infused into our economy without sending us into a serious recession. And this isn't easy. The common analogy often cited is that the medical doctor is charged or tasked with with taking the drug addict off of drugs cold turkey. How do you do that without sort of eliciting a response from the drug addict that is untoward? So after more than a decade of free or almost free money from the 2008 crisis to today, our economy has become addicted to debt, and its cost has been almost free. And to remove this free money drug, it's going to require some significant amount of pain, and we want each of you to know this is unavoidable. Instead of several small recessions and downturns during the course of the last 20 years, we're now confronted with one grand, potentially excruciating downturn. And of course, we're going to get through it. Yet because the enormous amount of debt we have on our balance sheet, we've created, I think, unintended consequences have a higher probability of happening. And it's the unintended consequences or the domino effects that we're afraid of. We can't detail them all, or we can detail many of them, but not all of them. And we just don't know when or where they're going to take place or how severe they're going to be. So here we are. We've infused over $10 trillion into our economy in less than 3 years. Helicopter money, some would label it. And the result is inflation. Yep. There are other events that took place, and they helped the inflation take place. Yet make no mistake, after trying to generate inflation above 2% for more than 30 years, we've been trying to get inflation up. The real how would I say, the real danger in our economy is deflation. We'll talk about that next month if you'd like to. But the fundamental drug which created the addiction and inflation was easy money. It was too much money. It was too fast. And now we have to find a way to tame the inflation beast. So Wall Street would love to convince you that they just need to withdraw the stimulus, and that we mistakenly gave the economy. Sorry. And there will be a downturn, yet it will be a shallow downturn. And on the other side, Wall Street's going to remind you that opportunities await. And this could be the future. It really could be. But it's unlikely that this is what's going to happen. The Goldilocks conditions of the last 12 years have really weakened our economy. And they most likely created expectations from the investing public that are truly unreasonable, as you're going to see. In fact, I've had conversations with families that are not the families that we represent. And I will tell you that they are expecting, between 10 and 15% a year for their 401k plans, or 10 or 15% a year for their their just basic investment accounts, and it's unreasonable. So what is the market missing? And this is the title of today's research piece. And it's interesting because the reason understanding what the market's missing is so urgently important is because the missing part, it's not priced into the valuations. And that's why we think the current market is extremely overvalued. And I'll go through that right now. So the market has priced in growth expectations for the next 5 to 10 years that we believe are completely unreasonable. Because the last 15 years of earnings have been aided by almost free money. This was the drug, and this free money is ended or is ending. Slide 5 shows the expected returns for each asset class over the next 6 years. So, yep, you're seeing it. For the next 7 years. U.S. large cap and small cap are expected to increase at about 1% or less over the next 7 years. There's a little bit better returns in some of the emerging markets, and the bond market is no different. We're in a heck of a case, especially if you're depending upon your money to grow to fund your retirement. So the most intelligent investors, those who base the decisions on data and valuation measures, they're all starting to come around to the reality that we've been living in what I've been calling, in the last couple of letters I've sent out to you all, a Goldilocks period for the last 10 years. In this period, it delivered great returns with very little risk. This period is going to give way to a period of little or no returns. This period could, of course, we could always be wrong, but it could give way to a period of no returns for the next 5 or 10 years. And I realize no one wants to believe this, yet before you decide, we could never have a period of 10 years in which investors have 0% returns. Take a quick look at history. Here's a chart that goes back to 1900-ish, a little even before 1900. As you can see, there are at least 4 periods of more than 10 years of 0% appreciation, and at least 3 of those periods or more than 20 years of 0% appreciation. What I'm trying to get at, it's an unpleasant point. We could very easily enter a period where investors who are counting on appreciation of their securities have no appreciation. And the only increase in their wealth may very well come from dividend and interest income. And if they've not created an investment allocation which primarily embraces dividends and interest income as the fallback, it's entirely possible they will have no return, and that will be uncomfortable. So here is what we believe Wall Street is missing, and it's an important point, yet one that requires a brief study of the last 20 years of economic history. Wall Street believes earnings will continue to grow at levels which are not likely. The more likely outcome is just the opposite. We believe earnings are going to shrink. And let me show you why we believe this is the case. But first, let me agree on a real simple formula. Earnings, or the return on your capital, define the value of your assets. So this is the preface that what I'm going to go over with you is, and if you don't believe that, then we need to talk about what you believe does define the value of an asset. So as an example, an asset which pays you $2 a year is likely to be worth more than an asset that pays you $1 a year. A real estate investment which pays $25,000 a year in income or rent is probably worth more than an asset or a piece of real estate that pays you $10,000 a year in rent. So in summary, earnings matter. In fact, earnings are probably one of the few things that matters. And they often define the value of an asset. Here's the problem. Wall Street's convinced the investing public that the markets, which we will call for today the S&P 500 market, are going to grow by 7% in 2022, more than 7% in 2023, and in 2024. We believe this is wrong and potentially incredibly wrong. Let me show you why this may be wrong. And over the next couple of years, earnings are as likely to contract as they are to expand at all. And when we discuss what this means, or I would say we should discuss what this means for valuation of the public markets. So since 2000, here's the backdrop. Since 2008, corporate profits have been substantially boosted by an increase in leverage. It's a sneaky method of increasing earnings. However, it's been going on without notice for many years. Take a look. Slide 7 shows the rate of increasing leverage corporate America has embraced since 2008. This is an incredible amount of leverage. Leverage allows companies to increase their earnings without any appreciable value creation. Slide 8 puts this massive borrowing in context with historical amounts of leverage, so you can see for yourself, the extent in which Wall Street has silently increased leverage to deliver increased earnings. So this is all in hindsight now. So this is not projecting anything, but I'll show you why this is important in just a second. So management has been borrowing money and using that money to show higher profits. Here's the model. Borrow money at 5%, make 6% or more on that money that you borrowed, and profits rise. It's an old trick, and it lasts until the music stops playing. And when the music stops playing and recession sets in, it leaves everyone looking for a way to now reduce their leverage. Yet it can't happen. You can't reduce the leverage without showing losses. And this lowers profits. And lower profits, lower valuations. What allowed this charade of leveraging America and showing increased profits? It all works perfectly well as long as interest rates are decreasing. So this whole charade works as interest rates are decreasing. Think about it. If I borrow money at 6% today and earn 8% on those funds, and in 2 years, I can refinance that money for 5%, and in 2 years more, I can double my borrowing at 4%. Each time I'm increasing my leverage and my interest rate is going down. Slide 9 shows how this works. Since 2004, corporate interest rates have been reduced by half. So while the borrowing has increased by over 400%. So leverage up, interest rates down. Increasing leverage, earning 8% returns for half the cost of the interest, enables corporate America to increase earnings at what we would say an artificially high rate without creating any value. This is just corporate restructuring. And this is what we call a Goldilocks environment. Plentiful amounts of money available from Wall Street. And who's more glad to lend and lower the rates? This is a recipe for higher earnings without any effort and without any value creation. And each company which is increasing its risks by taking on enormous amounts of debt, each of these companies receive a higher valuation, again, without creating any value. Yet it gets better, if you can believe it. Take a look at this. Slide 10 shows what happened in 2017. The former administration, just when the investing public thought corporate earnings couldn't get any better, the administration lowered corporate taxes. With one fell swoop, earnings increased by the amount of the tax decreases without any additional effort or no change in the corporate structure or corporate America. Corporate tax rates went from just over 30% to just under 20%, and corporate America massively increased their earnings again. Increasing debt combined with declining interest rates and lower corporate tax rates, as said, is the recipe for increasing earnings, which increase the value of financial assets. So our research's key finding is that the reduction in interest and tax expenses is responsible for a full third, so that's over 30% of all profit growth in the S&P 500 non-financial firms over the prior 20 years. The combination of all these things led to margin expansion, all of which, again, increase earnings. So here's the problem, and it's a big one. All of this is coming to an end. And this is the whole point of what Wall Street is missing. This is all coming to an end. Our belief is that the years ahead may very well show an unwinding of the Goldilocks conditions. Number one, increasing leverage to increase earnings will reverse itself. And less leverage may be required as interest rates increase. Less leverage will decrease earnings. Number two, increase in interest rates. This is going to create increased interest expense, which will reduce earnings. And number three, corporate tax rates, they'll either remain as they are or will likely increase, which could lower earnings. We don't have any insider information that's relevant there. We don't know of anything in the works, but I think it is highly improbable that we'll see tax rates lowered. Here's the result of what we've seen so far. Slide 11 shows the culmination of everything all in one fell swoop. When you add everything together, the end result is higher profit margins. And this is great, as every asset owner wants to see their assets deliver higher returns with no additional effort. However, now that we have inflation, interest rates must rise. As interest rates rise, leverage will shrink while earnings decrease. And while we really don't have any insider's knowledge about, as I said, about what will happen with corporate tax rates, we believe the odds are very low that they will be lower in the future than they are today. And as said, if change occurs, it's more likely that corporate tax rates are higher. So, and by the way, pay a little bit of attention to this arrow right here. This is this is what we're talking about happening. Margins are decreasing because costs are rising, and at some point, corporations won't be able to pass along these costs to the consumers. So the market is down about 20% so far this year, given one market's down more, one market's down a little less. What's the market missing? So we believe, and our research shows, that the next 5 to 10 years could reverse much of the friendly conditions created by free money from the administrations and the US Federal Reserve. If this happens, and it's entirely possible, so let me take that back. If this happens, and even if we have a mild recession, which I think is the definition of an oxymoron, that the tailwinds which have supported earnings have increased and have increased valuations may well become headwinds. And the headwinds could easily produce 5 to 10 years of little to no profit growth in earnings. And this will not be welcomed for those who are unprepared. So what's the market worth? Slide 12 shows what we believe the value of the market is likely to be once the changes that are likely to occur actually take place. And keep in mind that during this process, and in almost every negative period of our economy, the narrative gently and sometimes abruptly changes. The narrative change creates negative emotions, and negative emotions, as we all know, create bad decision-making. Bad decision-making probably create more selling than is necessary. And in short, before the final, or what we call the fair valuation, is reached, the market typically overshoots on the downside. So when all is said and done, even with a light recession and no serious external negative global events, the true value of the market is likely down about 20% from current levels. I want to add, with a fair amount of gravity, if unforeseen negative events trigger any type of cascade of negative domino events, or negative geopolitical events take place, our value, or the value of the capital markets, will be much lower. So let me stop there. And I've got 2 questions that were asked on the side before I left, and I'll answer them just a second. But let's stop there and find out if there are any questions. Marissa, you want to stop our recording so people can feel free to talk if they'd like to?